You have sold something you were right about. Maybe it was a stock. Maybe it was a house, or a business you almost started, or even a person. You did the homework. You called it correctly. And then you got out at the exact moment that being right became too painful to sit with. And you watched the thing keep climbing without you. Foster keeps a whiteboard in his garage for exactly this reason. It hangs between the water heater and a set of golf clubs he has used twice. A column of ticker symbols runs down it in blue marker. He read every earnings call. He stuck around for the analyst QA at the end, the part nobody else bothers with. And he was right. Ren sits 2 desks down from him. No whiteboard. Just a sticky note stuck to the bottom of her monitor that says, "Raise it." She has never once read an earnings call in her life. Ren retired in April. Foster is still working. He was right. That is the part that should unsettle you. My name is Yank, and I have spent an unreasonable chunk of my adult life studying the gap between being correct about money and actually getting paid for being correct about money. If you have ever picked a winner and somehow still finished behind, hit subscribe. Today we're breaking down the 3 unglamorous funds that have quietly built more 7-figure accounts than any single stock in American history. Let me name them, and then let me show you why that's almost the least interesting part of this story. They're the 3 exchange-traded funds that track the S&P 500, Vanguard's version, which trades under the ticker V, BlackRock's version under IVV, and State Street's version under SPY, which was the very first one ever created, back in 1993. Same 500 companies, same index, 3 different wrappers around an identical pile of stock. Combined, they hold more than $2 trillion. There's a real chance you already own one of them and have never once thought about it. And if you dumped out every 7-figure retirement account in this country onto a table, you would find these 3 funds, or their mutual fund equivalents, sitting underneath an enormous share of them. Your reaction right now is probably something like, so the answer is just buy the index. Thanks, Yank. Great video. You've heard that shouted at you from every corner of the internet for a decade. But almost nobody explains the actual mechanism behind it. Why should owning everything beat owning only the good ones? That sounds like it should be false. It sounds like being told the way to win a horse race is to bet on every horse, including the one currently eating the fence. Here's your answer. A finance professor named Hendrik Bissembinder did something almost nobody had bothered to do before. He pulled every stock ever listed in America going back to 1926, roughly 26,000 of them, every single one you could have picked, and asked one question about each, over its entire lifetime: did it beat a treasury bill? Not beat the market. Not beat inflation. Beat the most boring, risk-free, government-issued parking spot for your cash that exists. 57.4% of them did not. Read that again, because it should change the way you look at your own account. Most of the stocks you could ever have bought were, over their full lifetimes, worse than doing absolutely nothing, worse than just leaving the cash sitting there. And it gets stranger. When Bissembinder traced where the real wealth came from, roughly 4% of stocks produced the entire net gain of the American stock market. Not most of it. All of it. The other 96% combined gave investors about what a treasury bill would have handed them. 86 companies alone accounted for half of all the wealth ever created. And the failures were not gentle about it. Of those 26,000 companies, more than 9,000 were eventually delisted. The typical one took roughly 92% of your money down with it on the way out. So the market you've been picturing in your head doesn't actually exist. There's no bell curve where most companies do fine and a handful do badly. It's closer to a lottery, a small number of enormous winners quietly carrying a mountain of corpses behind them. Which flips your question entirely. When you buy a single stock, you aren't really making a bet on a company. You're betting that you personally found one of the 4%, and that you'll still be holding it years later, on the exact night it finally proves you right. Owning the index makes that bet for you automatically. You don't have to go find the 4%. You already own every single one of them. You also own the corpses, and it turns out that's fine, because the most any one of them can take from you is what you put into it, and there's no ceiling at all on the upside. That's the entire trick. It isn't a strategy. It's arithmetic. Foster's whiteboard, by the way, was his own attempt to hunt down the 4% by hand. And he actually did it. That's what makes his story useful instead of just sad. The man who first figured this out was treated, at the time, like a fool. In 1976, Jack Bogle launched the first index fund the public could actually buy. He hoped to raise $150 million. He raised $11.3 million, roughly 7% of his target. His own underwriter suggested they scrap the whole thing and hand the money back. Bogle told them, more or less, absolutely not. The industry called it Bogle's folly. That was the polite version. Somebody actually printed a poster of Uncle Sam declaring index funds un-American, which might be my favorite piece of financial marketing ever produced, because it accidentally tells you exactly who was making the money, and how. If a product that charges you almost nothing counts as treason, you've just learned something important about the products that were charging a fortune. And they were charging a fortune. In that era, it was completely normal to hand a salesman 8% of your money the second you invested, before a single dollar of it did anything at all. Then annual fees stacked on top of that, partly to cover the advertising that talked you into it in the first place, which is a little like being billed for your own kidnapping. Bogle's fix was structural, and this is the part almost nobody tells you. He set Vanguard up so that the funds themselves own the company, and investors own the funds. No outside owner skimming a cut off the top. So as the funds grow, fees actually fall, because there's nobody standing there with a bucket. Bogle could have become a billionaire many times over. He deliberately built a machine that made that impossible. The target date fund Ren was auto-enrolled into, the one she's never once logged in to check, is a direct descendant of that $11.3 million failure. 17 years later, a man named Nate Most, working at the American Stock Exchange, had a strange idea. His background was in commodities, and in commodities trading, you don't physically haul crates of tin across a city every time you trade them. You trade a warehouse receipt, a piece of paper that says the tin is sitting over there and it belongs to you. Most looked at that setup and thought, why can't we do the same thing with a basket of stocks? That idea became SPY. The exchange celebrated by hanging a 9-foot inflatable spider from the ceiling of the trading floor. It traded roughly 1 million shares on day one. Within a few months, volume had collapsed to around 18,000 shares a day, which in fund terms is barely a pulse. One of the largest pools of money on the planet nearly died of neglect in its very first summer. I bring up the spider for a reason. Whatever eventually ends up eating the world starts out looking ridiculous to everyone. And whoever is selling you the exciting alternative will always be better funded than whoever is selling you the boring, correct answer. Which brings us back to Foster, because I told you he was right. Now I have to show you what being right actually cost him. The company at the top of his whiteboard is a chip designer that everyone today treats as inevitable. Holding it would have made you spectacularly wealthy. It also would have required you to sit through 4 separate stretches where it lost more than half its value. In one of those stretches, it fell close to 90%. It took 4 full years just to climb back to where you originally bought it. Or take the streaming company on his list, down about 76% over 7 months, with no recovery for nearly 3 years. Or the online bookstore that eventually became everything, down roughly 94% when the dot-com bubble burst in 2000. Your hypothetical $100,000 becomes about $6,000, plus a concerned phone call from your father-in-law. This is the part every 10-bagger story conveniently leaves out. The chart looks like a staircase to heaven when you're looking back at it from 20 years away. Lived forward, one day at a time, it's a long stretch where you look like the dumbest person in your own life, to everyone around you, and eventually to yourself as well. Because here's the thing, Foster was right about the company and wrong about himself. He sold 2/3 of his position during one of those collapses, at 4 in the morning, standing in his kitchen staring at his phone, after 11 straight weeks of watching it fall, at the exact point where the case for holding on had stopped sounding like reasoning and started sounding like denial. So let's actually run the numbers, because this channel doesn't get to just assert an outcome without showing you the math. Give both of them the same paycheck, $600 a month, for 25 years, both starting the very same week. Foster spreads his money across 11 tickers on that whiteboard. One of them is the monster winner. The other 10 are not. And per Bisembinder's research, those 10 together do roughly what a treasury bill does, which is close to nothing. Now watch what that quietly does to his outcome. His entire result ends up riding on one single name, and that name only ever holds about a tenth of his total money. Then he sells 2/3 of it near the bottom, and it goes on to climb several times over without him. That's the whole story right there. You don't need a crash to lose. You just need one bad night in the middle of otherwise being right. Ren, meanwhile, puts her $600 into a single index fund every month. Except her $600 isn't really $600, because her employer matches part of her contribution. So roughly $900 a month is actually going to work for her. Notice exactly what she did to earn that extra money. She filled out a form. That's the entire competitive edge. She never sells, because she never has a reason to. You can't lose your nerve over a company you can't even name. Run the full 25 years, and Foster isn't destroyed. He isn't wiped out. He just finishes behind. And there's a specific number for how far behind, which I'll give you at the end of this video, because it's smaller than you're expecting and worse than you're expecting, both at the same time. So understand what actually happened to him. He had better information than almost anyone in his entire office building. What he didn't have was a system that let him be publicly, visibly, continuously wrong for 11 straight weeks without touching anything. And if you're honest with yourself, you probably don't have that system either. Almost nobody does. Your own 4 a.m. moment has a price tag too. Morningstar tracks the gap between what a fund actually returns and what the people invested in it actually take home in real life. That gap runs somewhere around 1 percentage point a year. To be fair, some academics argue the real number is smaller than that. Either way, it points in one direction, and that direction is away from you. The older research is even uglier. 2 researchers went through tens of thousands of brokerage accounts, just like the one you probably have. The households that traded the most earned around 11% a year. The market, over that exact same stretch, was handing out closer to 18%. Those people weren't stupid. They were busy. Somebody actually put real money on this question. In 2007, Warren Buffett bet $1 million that a plain, ordinary index fund, the kind you can buy from your phone today, would beat a hand-picked lineup of hedge funds over 10 years. A man named Ted Seeds took the other side of the bet. He selected 5 funds of funds, meaning hundreds of some of the best-paid investors alive, all free to move in and out of anything they wanted. 10 years later, the index fund was up about 126%. The professionals, on average, returned roughly 2% a year, total. Buffett later instructed that the money left to his own wife go almost entirely into that same index fund, which is a fairly loud statement to make if you built your entire fortune picking individual companies. Now let's talk about your own account, because this is where most finance content quietly lies to you. Fidelity tracks tens of millions of retirement accounts. Their most recent count puts the number of 401k millionaires at roughly 645,000 people, with an average balance of about $141,000. And if you just compared your own balance to that number and felt your stomach drop, stop. That average is a lie. Not a false number, but a lie by construction, and here's how you catch it. The median, meaning the actual person in the middle, where half of everyone is above and half is below, sits at about $32,800. The average is more than 4 times the median. A handful of enormous accounts are dragging that average way up, the same way one billionaire walking into a diner raises the average net worth of everyone eating pancakes in the room. Vanguard's own numbers tell the identical story, average around $168,000, median around $44,000. So you're closer to normal than that headline number made you feel. And any channel that hands you the average without also giving you the median is either being careless or actively selling you something. But underneath all of that is the number that actually matters to you. Those millionaire accounts are not stuffed with exotic stock picks. They are full of index funds and target date funds, which themselves are mostly index funds wearing a costume. Roughly 2/3 of Vanguard participants sit inside a professionally managed allocation, most of them in a single target date fund they were automatically placed into. Which means a huge share of American 401k millionaires got there through a default setting, a form they filled out during onboarding while an HR manager waited for them to finish signing, which is either inspiring or genuinely insulting, depending on how much effort you've personally put into your own portfolio. 2 structural advantages before we get to the uncomfortable part. First, fees. 2 of these 3 funds charge you 0.03%. That's $30 a year on a $100,000 balance. Compare that to the average equity mutual fund, which charged well over 1% back in the 1990s. Foster spent his first decade invested in one of those funds, effectively paying for the privilege of underperforming the exact thing he could have owned for almost nothing. That gap sounds trivial when you read it as a single number. Compounded across an entire working life, it's the difference between actually retiring and continuing to receive work emails. Second, taxes. Because of how these funds are structurally built, they can shuffle their internal holdings without triggering the capital gains distributions that mutual funds hand shareholders every December like clockwork. In a recent year, only around 7% of exchange-traded funds passed along a capital gains distribution to shareholders. For mutual funds, it was over half. VOO, Vanguard's fund, has never distributed one since the day it launched. So if you're investing in a regular taxable account, you're not just paying less to a manager, you're frequently not paying tax on a gain you never asked for and can't even spend. If this kind of thing is more interesting to you than you expected, I run a paid community where we go deeper on exactly this stuff. No pressure, links below. It's mostly people comparing notes. Now let me spend a few minutes arguing against myself, because if I stopped here, I'd basically be doing the same thing as the un-American poster people, just aimed in the opposite direction. First, what you're buying today is not what your parents bought. The 10 largest companies now make up roughly 40% of the S&P 500, the highest concentration in more than half a century. So you put $1 million into what's marketed as the most diversified product ever sold to ordinary people, and roughly $400,000 of it lands in just 10 companies, most of them making a similar bet on a similar piece of technology. Which means Ren, who has never picked a single stock in her life, actually owns a more concentrated position in one industry than she has any idea about. Second, 3 asset managers between them are the largest shareholder in something like 88% of the companies inside that index. Whatever you make of that fact, it happened because millions of people just like you quietly checked a box on a form. Third, and nobody wants to hear this one, nearly every major forecaster expects your next decade to be worse than your last one. Vanguard's own model puts American stock returns somewhere around 4% to 6% a year over the next 10 years. Other forecasters are gloomier still. So if the retirement calculator you're using simply assumes the last 10 years will repeat themselves, you're not really planning. You're hoping, with a spreadsheet open in front of you. Go run your numbers again at 5% and see whether the plan still works. Index funds are also not immune to long droughts. The Japanese stock market peaked in 1989 and did not reach that level again for 34 years. American stocks went essentially nowhere for the 13 years following 2000. Buy and hold does work. It just occasionally works on a timeline longer than the one you personally have. And there is a genuine argument against everything in this video that deserves to be said plainly: individual stocks are what build the biggest fortunes. Nobody has ever become a billionaire through an index fund. Founder equity, employee stock grants, one concentrated bet that actually paid off, those are what produce the truly enormous outcomes. Concentration builds wealth. Diversification protects it. Those are two different jobs. And if you confuse the two, you'll either stay careful and stay poor, or get rich briefly and hand it all back. One more piece of honesty. The reason most people never reach 7 figures isn't that indexing failed them. It's that the compounding got interrupted, cashed out during a job change, borrowed against for a new roof, paused during a rough year, and never quite restarted. The median balance really is $32,000. Not because the math is broken, but because life keeps reaching into the machine and pulling money back out. So here's the number I owe you. Run Foster and Wren both out to the very end, and he isn't ruined. He isn't wiped out. He lands somewhere close. He finishes behind by roughly the value of 4 extra years of showing up to a job he was already ready to leave. That's the entire penalty, for years of his life, not a catastrophe. And that's exactly why you need to actually understand this. Nobody is ever going to warn you about a mistake that only costs you 4 years. It won't look like a mistake while you're making it. It will look like you being careful. And I want to be clear about where the blame actually goes here, because it isn't on Foster. He did the reading. He was right, more right than the entire industry that spent the 1970s calling index funds treason. The system asked him to be brave at 4 a.m, alone in a kitchen, with nobody watching and nobody around to tell him he was still correct. That isn't a personal failing. That's a badly designed system. Nobody should have to pass that test a dozen separate times over 30 years just to retire on schedule. Wren never had to pass that test. She never even took it. Her system never required courage from her, and that isn't laziness. That's the highest form of design there is. I'm not a financial advisor, and none of this is financial advice. I'm just someone who reads too many footnotes and figures you deserve the actual math instead of a screenshot of somebody's brokerage app. Wren spent the first Tuesday of her retirement doing absolutely nothing of consequence, which she has fully earned and cannot stop bringing up. Foster's whiteboard is still sitting in the garage, between the water heater and the golf clubs. The tickers haven't changed. He was right about every single one of them. He's still going in on Monday. So somewhere in your own life right now, there's a decision you keep getting right in theory and wrong in practice. The diet you could explain perfectly to a nutritionist. The habit you understand completely and abandon by week 3. Money isn't special. It just keeps a scoreboard where everyone else can see it. Which means your real question was never, which fund? Your real question is, what would you have to build so that being right stops depending on you feeling strong on a bad night? Tell me in the comments, what's something you sold that you were actually right about? I want to know what the room looked like. And if you want to keep pulling on this thread, our community is where that conversation keeps going.